Good evening, everyone. It's Thursday, April 3rd, 7:30 p.m. I'd like to call this a regular meeting of the Darien Board of Finance to order. This is one of our budget work session meetings, and there'll be two primary items we're going to go over today. One is going to be looking at setting the collection rate, the percentage of the taxes that are levied that we believe we bring in, and the other one is going to look at contribution from fund balance and or from surpluses from this existing year. So as is always the case, we start off the meeting with public comment. Is there anyone here that would like to make any public comment? Seeing none, we'll move on to our discussion and action, which is, Jen, how about we start first with the general fund?
Sure. So it's not pretty, it's not complex, but I put this together before the meeting, looking at potential fund balance contributions, what the change in tax rate would be, what our Moody's ratio would be, and what our fund balance policy percentage would be. So ranging from, with the changes that we've incorporated so far, so definitely would change these numbers if we make any other cuts or additions. But if we were to do no fund balance contribution, our tax rate increase is 7.45%, which is a little different than what you had in the file. I found that it was double counting a $100,000 revenue increase. So the tax rate would change, would be 7.45%, would be at a Moody's ratio of 22.79. The threshold we want to keep in mind with that is 20%. And for the BOF policy, we'd be at 20.16%, and our target on that is to not go below 12%. So I did it in $500,000 increments. I did provide you with the fiscal 24 projection, and we're at this point projecting a surplus of $3.2 million. That includes about $1.8 million on the revenue side and about $1.6 million on the expenditure side. The only caveat I will say on that one is it does include the $460,000 for the Board of Ed, and they are having the discussions about setting up the non-lapsing fund. So I think
you said it does include, or
it does.
Okay.
So
the 1.5 includes that.
The 1.5 assumes we get 460 back from the Board of Ed. So just something to keep in mind as we think about what we have available.
Jen, what's their time frame to have an answer?
To set that up, I think they're looking to vote on it in May.
It's May 15th, the day after the RTM votes.
Yeah.
Hey, Jen, in your first slide that you had up, does do those percentages in the far right reflect the surpluses that are going back into the general fund?
Yes.
So, okay, so they're trued up for that.
Yeah.
But they're net of the so just on the $3 million row, that assumes all of those dollars that you showed on the other page go back in, and then we take $3 million out.
So
Right.
3.2 goes in and 3.0 comes out.
Exactly.
Got it.
Thank you.
And does this include, in terms of the Moody's, is this net of the bond, the expected bond proceeds that we'll have outstanding as of June 30th?
Yes, this is looking at the fund balance ratio, and because that's the lower of our two. Our liquidity is the one that gets very skewed by the bond proceeds coming in towards the end of the year. So their fund balance ratio actually only looks at unassigned fund balance, which in capital projects, we don't have that. So it kind of, this ratio kind of discounts the bond proceeds coming in.
So can you go back to that for a minute?
The Moody's?
Yeah.
Yep.
When does the ban mature?
Well, it matures in a week, but because we're rolling it, it'll continue to be considered, we'll have a negative fund balance in the Great Island Acquisition Fund, but we'll have a $49 million ban payable. And so Moody's, when they look at, or our financial statements will show a negative fund balance, but Moody's gives us credit for the fact that the ban is there and that it will be converted to long-term debt.
But the ban matures?
It matures in a week because we did 1 year, and now we're going to reissue and roll it for another year. So the plan is to have it roll for a year and then bond it in April of 2026.
Just a question, given that we're going to market on Tuesday,
Mhm.
the bond matures on,
Sorry, the end of April, yes. The sale is next week, the closing is the last week of April 24th. So that's when it matures, that week.
got it, okay. So we are closing before
Yes.
that maturity.
Yes.
Okay. And then the unassigned balance, that's what you're starting with, or is that inclusive, that's inclusive of all the sort of surpluses coming back?
Right, this is a roll forward from our June 30, 2024 unassigned
Yep.
fund balance, which was 33. With the 3.2 that we're projecting, it goes up to just over 37.
And when we were at 33 last year, we contributed how much?
Altogether, you used about $3 million of surplus. You put just under 1.7 into the budget, and then you did the 750 or whatever, the 700, 800,000 for the school transportation and the $1 million for the school security.
Jen, is the first slide that you had up there, is that in our spreadsheet? Or
No,
you
I
don't
just
have it?
did this right before the meeting.
Okay, all
So
right.
I'll send this out so that you have it, but it wasn't in there
Yeah, that's
yesterday.
fine, thank you.
The one thing I do have in my head is that Moody's 20% threshold. So what they do is they measure our fund balance ratio against our total revenues and their GAAP revenues. So they include the on behalf teachers' pension and OPEB payments, which are north of $20 million. But as our budget grows, obviously, the total revenues grow as well. And so if we were to keep fund balance the same and our budget continues to grow, that ratio is going to drop. So I would just caution, if we're projecting 3.2 million fund balance, we may not want to use it all. And I think last year we had floated the idea of coming up with a policy of we use 75% of the projected fund balance or something like that, coming up with an approach.
I think last year we used 50%.
Yeah.
Of the projected
But I don't,
surplus.
of the
Of
projected
surplus.
surplus, yeah, sorry, not of fund balance.
Yep.
Just so that we have some kind of a method to it, because we do need fund balance to grow along with the budget growing to keep our ratio in the right range.
Is Moody's familiar with the fact that we've traditionally been taking our surpluses and using those?
Yes.
And they're comfortable with that as long as these ratios stay?
Yeah, and they're comfortable because we're not using it to fund operating expenses.
Right, right. Yeah, as long as they're, right, as
Yep.
long as they're tax-supported capital.
Right.
Right.
And, if we were to drop below 20% because we had some odd anomaly or circumstance, it wouldn't be an automatic issue with Moody's, especially if we said, here's what happened, this is why, and here's our plan to get it back up. But if they see a trend of a declining fund balance ratio, that's when they would start to get concerned. And I really do think we need to keep that in mind, because the flip side is we know that we're rolling on a lot of debt over the coming years, and that our outstanding debt is going to go up, and that's another area that they look at. So we don't want to get weaker on something in addition to the more outstanding debt.
Well, we went up by $6.5 million this year, right?
No, like 2.4,
Like
2.1.
is the 220 the denominator?
Yes.
And last year that was 213, is that right?
Total revenues, I thought you were talking
Oh.
up in fund balance. Yeah, that's total revenues. And this is just a projection. And I do think that this is understated a little bit, because if you look at total revenues, I adjust the general fund with the projection, but the other funds, not as much. And same with, primarily on the fund balance. I don't do a fund balance projection for the sewer fund, for capital projects, those sort of things. It's just a carry forward from what was there last year.
But I guess what I was saying is, if we went up by approximately $6.5 million,
Mm-hmm.
and applying the Moody's 20% rate, that means like it's an extra $1.3 million
Right.
that we need next year more
To
than
stay
we
at
need
the
this
same.
year.
Yeah.
John?
Yeah, so if you look at some of the debt projections that I did, if we assume, say, some of that, I know it's tangential to this ratio calculation, but does any of that from your discussions with them imply that Moody's would request or require a higher percentage threshold for fund balance?
No. What they do is they compare our fund balance to other rated municipalities, and we actually fall into the, I think we're on the cusp of the AA, going from A to AA, I can't remember offhand. They know that Connecticut typically has lower fund balance levels because we rely mostly on property tax, which is a very stable revenue stream. So we don't need a lot of fund balance to offset volatility like you might have in places that rely on sales tax or some places that even rely on like mining revenue. So they kind of give us a little notch to acknowledge that we're really strong on fund balance for Connecticut, but comparatively, we're well below fund balance levels for AAA.
Okay.
So when you go back to your page, your sheet 1, if we assume our need is going to go up by $1.3 million, how should we read that table in terms of
Well, if we're
pro forma
comfortable,
for next year?
if we're comfortable assuming the 460 from the Board of Ed comes back to us and we say projection is 3.2 million, and we know that we need fund balance to grow 1.3 million to stay at our same ratio, I would say that gives you 1.9 million to contribute. Because 3.2 minus 1.3.
In addition to the money coming back, you're saying?
No, from the money coming back. So if, right now, if we did nothing, no fund balance contribution, and my projection were perfect, which we know it's not, we would grow fund balance by $3.2 million. And if we assume that revenues grow by $6 million, if we want to stay at the same, that would increase fund balance more than the 1.3 needed to keep our ratio level. So our ratio would be better.
I guess what I'm saying
That's
is, what do you want
assuming
to
that
keep?
next year there's no surplus.
Right.
Yeah, but what if we wanted to keep it at 20% next year? So 20% of this year. So like 5.
So when we go to get rated at this time next year, Moody's is going to look at our 6/30/25 financials. So that's why this is only projected 1 year out. We could roll it forward another year, but that would be a lot of assumptions.
No, I guess I was just trying to understand, like, if we assume the same change next year in terms of the overall budget, so therefore our budgeted revenues, 20% this year, where do we need to be at? Do we need to, I guess the maximum, we could take it down to 21% of this year, because then that would keep us at 20% of next year if we had no incremental revenue or surpluses coming in?
Yeah, probably in rough terms.
Go back to that sheet, please.
So I guess what I was saying is, let's just assume 5 million is 20%. Feels like we should leave at least $1.3 million cushion at the minimum.
I would recommend that you do not draw down anything more than what we're projecting as a surplus this year.
Can you explain how you're solving? I got lost there in the 1 point. How'd you come up with the 1.2 or 1.3?
Our,
Am I the only one
our
that's
revenues
lost
are
there?
growing 6 million, 20% of that
What revenues
number.
are we talking about?
The denominator for Moody's, which is total revenues across all of our funds.
Like
Our-
tax?
Our
revenue?
budget's going up by
Primarily
6 million
tax.
year over year, and you need to have 20% of that number in fund balance for Moody's. So
Right.
20% of 6 million is 1.2, 1.3.
Okay.
Jen, can you go back to,
And they measure the budget.
And
by
we're
way.
expecting a 3.5, that was $3.5 million
no,
surplus,
actually,
so minus
1.2.
1.3
Can we
is dedicated
see
to what?
3.2.
the three items again that
That
make
means
up
2 million we can dedicate,
the
right?
$3.2 million
Well, you have
difference?
another
Yeah. Without a-
1.3
Or I call it a
anyway,
positive,
right?
right?
Yep.
So we got $1.8 million of more revenue. de minimis on the contribution and the expenditures. So like we have a positive 3.2. That's irregardless of fund balance at this point, any contribution, right?
Right.
So am I looking at this wrong where I think that's 3.2, call it 3.2. Your other sheet there has $3 million, right? So that's like a positive 6 million, right? Or am I-
No, this
or-
would be using 3 million of that 3.2. So
So that's not a,
it's not in addition, this is a drawdown of fund balance. So if we add 3.2 at the end of the year,
mhm.
but we draw down 3, we're really only adding $200,000 to fund balance.
But in the past, have we been net adding every year?
To fund
I guess we
balance?
have.
Yeah.
Okay.
Yes, because if you look at all the surpluses that we've had in terms of reduced expenditures and increased revenues,
Yeah.
right? Those, for the last few years, and increased tax revenues, right, collections, those have always been greater than the amount of cash capital, non-bonded capital that we've had. So for instance, we've had, $4 million worth of kind of excess surpluses coming back in, but we only had $3 million of capital.
Right.
So we would only roll 3 million of those surpluses into new capital, and 1 million would kind of go to increase. This year, it's a little bit different. We have 4.88 million of cash capital.
5 point something. Town is 4.8, and then the 1.3 from,
So that's
where's
6
that?
point,
I think it's like 5.9. Let me see.
Okay, sorry.
So that's our kind of upper limit.
Yeah.
And we, not suggesting that's anywhere close to what we should be drawing, but that's our upper limit,
Right.
is 5.9 million.
Yeah, so since that's our upper limit, right, this is the first year where the maximum amount that we would be able to roll would not, like, we would never be able to fund all of our capital.
We're not governed by cash capital this year, like we have been in the past. So it's really more about a judgment as to what's the right thing to do vis-a-vis the right level of fund balance. It seems to me a little bit overly conservative to take all 1.3 of a projected next year
Yeah.
growth and just take that away, because we've always had surpluses. So,
And I will admit that my projection is conservative also.
yeah, so,
So if we go back to 3 million, if we go back to the 3 million table on sheet 1.
yeah.
And if I was to extrapolate down to 20.00%, that should be about $6 million.
Right.
So if we put in $3 million,
Yeah.
and 20% would be 6 million, that would mean we'd have 3 million left over, which based on the growth this year and our needs of 1.3, that would give us a couple years, kind of 2.5 years of cushion.
It seems to me like 3-ish is kind of the right zip code.
It does, and then if we had any further reductions, so we could bring it down. to
Not
5.
3.2, not 3.5.
Right, I think 3 is
3-ish.
the upper limit.
Yeah.
Understood.
Yeah.
Three leaves us with $3 million of cushion above the Moody's limit, and if our annual increase is the same, we would, ceteris paribus, be using up $1.3 million of that next year. So we're really sort of leaving 2.6, sorry, 1.6 of cushion for a year from now when we're having this discussion.
Yes.
Do you have the fund balance just in total? Like, is it 32 million, 34, 38?
Assuming no
37
more
surplus.
Yeah.
It would be 37, which is our full 3.2 growth, so if we used 3 million, it'd be 34.
And in there is those surpluses, lack of a better word, we just talked about.
Right.
So I'm saying that's flowing back in. I think we use at least 3.
The, Jen, I
At least
think
what?
you said the other night
At least
that the
3.
principal reason for the town generating
I don't agree with this.
revenue surplus is taxes, to our assumed tax collection rate.
Yes.
If we were to adjust our tax collection rate upward modestly, would you feel different about that chart? Because the likelihood of a surplus for next year would go down.
You know, it's interesting. This is, I think we've caught up on investment income because that one was generating a lot of surplus for a couple years while we were trying to catch up on that. So this year, out of the 986,000 of that is surplus tax collections over what we expected. But I think close to 200,000 of that is higher than budgeted supplemental motor vehicle and real estate taxes. So it's not off of just the general levy. So about 780,000 from tax collections, just regular tax collections. Tipping fees, we have 600,000 surplus projected. That's also one that we're chasing because of volumes. When you say a modest increase in the collection rate, how do you define modest?
Well, so, thank you for the information you sent me earlier today. So, over the last 5 years, the lowest tax collection rate was 99.66. Let me set aside. We're assuming, we've typically assumed about 99.5, 99.5% collection rate.
Mm-hmm.
And on average, it's been closer to 99.775 is kind of what we actually collect. So we've been leaving about 25 basis points. One might argue we've been overtaxing that 25 basis points, and then we just return it at the end of the year. So the question is, should we examine that? And I would never advocate going all the way up to what our actual collection rate is. But the question is, there's 25 basis points in there, 99.5 to 99.75. Should we go to 99.6 or cut it in half?
I think there's room to discuss that. Several years ago, the Board of Finance switched to the rolling 5-year average less 25 basis points is the budget collection. For one thing, similar to, fund balance ratio goes down as your denominator grows. Our budget is growing. And so that 25 basis points has become a higher number.
A higher number, right.
And a larger cushion than it was the several years ago that we put that in place. So I think it can be discussed. I don't think moving it up above the way that we've been doing it is problematic.
Okay. So I just ran some numbers that, if we went to 99.65, it would buy down about 16 basis points in the percentage increase in taxes, assuming approximately a $3 million fund balance contribution. So if you put in a $3 million fund balance contribution and raised the tax collection rate to 99.65, which I would suggest is the upper limit of what we should be thinking about, then I think the math took a mill rate increase from 558 down to 542.
That's kind of like a one-time change though, right? Like I wonder if we should reserve that for a future budget where we need to pull a string like that and do something more like the ECR strategy.
Well, there's a lot more money here than there is in the ECR. So, and we are returning.
How much was it total?
We're returning revenue every year because we're underestimating our tax collection rate.
Yeah, well, it's flowing note as part of the surplus into the next year. I mean, it's just a delay.
That's the same thing in ECR. So,
No, but next
but
year
we're overtaxing. The point that was made the other night, we're overtaxing.
I get it.
Right? We're overtaxing our residents and returning it at the end of the year, which is great, but we shouldn't have ever taxed it to begin with, one might argue.
Yeah, no, I get it. You said changing it by as much as you proposed was how many dollars?
I don't have the dollars, I just have the percentage. I'm not that facile with Jen's spreadsheet. Jim would know what cell number it would be.
It's about 235,000
So it's the same.
based on the 24 collections.
164,000 for every 10 basis points increase in the collection rate.
Yeah, and I had increased it 15 basis points, so you're both right.
And it's the same as ECR.
Hey Jen, just to make sure, when we use the word
Yeah, but we're
collection
adding a
rate,
discount to what our actual.
is the numerator is like the taxes we're gonna dial in and assume we collect today?
Yes.
Or, sorry, is the numerator the amount of taxes we actually collect, and the denominator the ultimate amount of taxes that are due based on the grand list we know today, adjusted for BAA, adjusted for kitchens and bathrooms, adjusted for cars, adjusted for all those supplemental settlements and so forth?
Not for the supplementals, that's backed out. That's backed out of my analysis. If you were to ask Kathy what her collection rate is, it would include the supplementals, what she collected on them, what they added to the levy for the numerator and denominator. What this looks at when we say percent of final levy calculated, or percent of final levy that we collected, the numerator is tax collections minus refunds minus overpayments. So the money that came in that we got to keep. The denominator is the beginning levy plus certificate of change, additions and reductions. Not BAA. BAA is before the tax bills go out. That changes the value. It doesn't change. And that's before they send out the tax bills. The certificates of correction are for things that occur after the tax bills are issued.
Got it. So it's not just, I say physical collections, like how many dollars, it's what we're assuming today versus what we're ultimately billing, right? Because there's some creep up or down or change in the actual mill list.
Right, so we have an estimated mill rate, an estimated levy based off of the mill rate that we calculate through our whole budget spreadsheet against the net grand list. And so this is our, like in fiscal '24, we estimated $155.9 million levy. The actual levy, after all the certificates of correction and everything was finalized, was $155,869. So it was only a $31,000 difference. The actual levy was $31,000 less than what we assumed. They've been pretty close. The furthest we've been is a 0.06% difference in fiscal '22. So there's not that much change that is occurring from what we're assuming.
So it's really not grand list driven change that's affecting.
Right, because that's factored in beforehand.
Got it. And then is there any, in terms of past due taxes, is there anything being accounted for in terms of the things related to foreclosure,
So
blight actions, things like that?
In the tax office budget, there's a separate line that is not part of the collection rate calculation. They have a separate line for prior tax collection. Typically, we budget $250, $275, $300, and for fiscal '26, the tax collector is suggesting that we keep it at $275, which is what we have this year. When she puts that together, she thinks about what does she have outstanding. So if we have if current collections spiked in one year, we're going to have fewer prior collections in the next year because we got them in on time. But she factors in what she knows is outstanding. She's always reaching out to them. She has a pretty good sense for who's she can get collections from for past due. So she thinks about all those conditions when she puts in her number for prior tax.
But she's not budgeting for blight fines or any of that, that's all.
No,
That's all.
Or like I think there's a foreclosure proceeding underway.
That's
Yeah,
well
and
into, that's years, that's a long time from now.
But if they're
it's not
delinquent,
budgeted.
then we would be first in line.
Got it, okay.
Not budgeted.
So you wouldn't object to a 10 basis point increase in the assumed tax collection rate?
No, I think I would say let's try it. We have a sufficient fund balance. We have a conservative projection for this year. We have probably some conservative revenue numbers in the fiscal '26 budget. If we find that it's too high, we can absorb it in fiscal '26 and we can address it when developing the fiscal '27 budget.
So I guess, not that we're making a decision tonight, but is 10 the right number? Should it be 12 and a half and just split the difference, or?
I thought you said 99.65.
Well, that's just my number. So
But
we've
we're
been
at
at
90 but we're at 99.5
versus
now, right?
99.75, so 99.625 would split the difference.
Last year was like.
But it's really, it's
Right.
$160,000.
For 10 basis
Right.
points, right.
And so going back to the that sheet one, Jen, like $500,000 is worth 55 basis points, I think.
Uh,
30
the
basis points.
Tax rate change,
Yeah.
30 basis points.
So it's about 10, so a 10 basis point increase in the collection rate is approximately a 10 basis point decrease in the.
Right.
In
It's virtually all our
tax rate
revenue,
increase
tax
is
revenue,
that's
like
the mill
like
rate,
for
right?
like
That's not the
change.
tax levy?
Right.
Yeah.
Yeah.
So I kind of feel like 10 basis points or 15, what are we?
I'm comfortable with 15. When you look at the history because I think the point is, it's not just collection rates, right? It's not the collections amount, it's the sheet that you showed that has, I call it the collection apparatus, if you want to call it that. It's everything else that's involved. We're just kind of putting a number in here. But Jen, can you show that 5-year thing you just had, where the most we're off is 0.06?
Mm-hmm.
And every number is above that 99.65? I mean, I don't know if.
That's kind of
That
right.
gives me comfort that, yeah, that sheet, right? Let me look at those numbers, right? We're basically, 5-year average is 99.75, or 7.7, or 7.5, go back to the original one. 99.75, and we're 10 under that then.
So
I don't know if everybody else is comfortable with that, but I am.
Comfortable with that.
So we're talking about a
15 basis point
99.65.
increase?
I'm
Yes, up
comfortable
from
with that.
99.50.
We were at point.
We were at 99.5.
We have a cushion.
So I just,
In 2020.
Yeah.
just looking at history, I do want to point out fiscal 2020,
Everything else
which
is
started
better.
July of
Yeah.
19, ended June 30th, 2020, so COVID, but that didn't really impact our taxes the way we thought it might. We collected 99.66, and that is a low point, but it has happened. So if you do 99.65, just understand that you are very close to our actual low point in the last 5 years.
Yeah.
Yeah.
But 10 basis points below our average.
Yes.
Yeah, I mean, listen, there's also a few things going on this year, like debt service, we have an unusual sort of step up
Yes.
versus others, so we could certainly take it from 99.5 or 99.48, I guess, to 99.65. And next year, if we're not looking at such sort of a one-time increase in debt service, we could always bring it back to 99.6 if we needed.
You're not.
But I do think we
You don't
should,
think?
It's hard to move backwards.
well, I do think we should we should aim for to be more precise.
I
Because
agree.
that way we don't overtax. And so, but we have to be careful not to try to get too precise and then miss.
Right, and this
So
is
there
part
has to
of
be a
how we
cushion.
have been able to grow fund balance and maintain a strong percentage on an ever-growing denominator.
Fair enough, yes. The surpluses are what generates a fund balance increase.
Yeah.
Yes.
Does Kathy see this?
Yes, and she would be very uncomfortable with moving up to 99.65.
Tell her to stop being good at her job and we don't have to worry about it.
I think we'll have Ralph deliver that
This
message.
is a promotion.
It has
This is a
been
promotion
observed
builder
in the
right
last
there.
5 years. I think maybe 0.6 would be a better idea. Like,
Which
I don't
one?
know that we
Yeah.
want to get that close to it. I mean, I know we have enough reserve, but like Jen said, we're not going to go the other way.
Why not? Like, if we only got
'Cause then you're adding-
99.65 this next year, then maybe that's not enough cushion, we change it next year.
It's gonna
And then
be
you're gonna be adding to the
painful
budget.
to
Yeah,
move it down.
I know, yeah.
The other thing to consider is this year's tax is not going up by our typical 3.5%. And so if you're going up with a larger percentage, you may not have the same collection rate as what we had in the past. I mean, it's just something to consider. I'm more comfortable personally with 10 than 15. And then if we see that it still goes, then again, you have 15 next year.
That's true.
I mean, you're still going to have a high increase this year, one way or another. If it's 15 or 10, it's still not our typical 3.5.
And I do think on top of that too, economic conditions are cutting into people's ability to pay, or may cut into people's ability to pay. And we may not see the same quick payment for 99.8% of the bills.
John, do you have a point of view? You've been around this for a few years.
Yeah, I mean, the adjustment we put in place, what was it, 5 or 6 years ago, was simply to give some stability to this, but something that would be consistent over time. I think actually, Dan, your idea of making that adjustment, given now that the budget's inflated from where it was when we did that, makes a good idea. I don't know about getting close to the trough, if you will, as Jennifer described. You know, maybe 10 points is the right number, just to say that in terms of the adjustment we made, it's closer to the average, but it is below the lowest point that we've seen, and stick with that. But, I mean,
In terms of 99.6?
yeah.
You go to,
I mean, does it make sense in terms of, we're all in agreement, I hear at least 99.6?
Yes.
Yes.
So does it make sense to kind of put in the spreadsheet 99.6 now, factor in some of the other things like fund balances and so forth, see where we are, and then we can
Yeah.
maybe make a decision about whether we feel the
Yes.
extra 5 basis points is, you know,
Yes.
is warranted to get the extra 5 basis points of mill rate?
yeah.
Sorry, can I ask a question? Sorry. Parasexa. Statistically, you've done the 5 years, but if I recall, we haven't had a recession for 10 years, a long time. What happened when you had recessions? What happened to the collection rate? Because if we go into that period, you might have more pressure on this.
Well, if we go back 10 years.
Can you go back to 08, 09?
I don't have that.
Don't
I'm
have
gonna go
that.
back to 13.
It's just been a long time since we've been in a recessionary period. and I
Yeah,
just
and
thought
we,
you
we
should
had
think about that.
99.43 and 13, 99.31 and 14, a couple of 99.6, 0.61, 0.74. It's gone up recently. There's been an upward trend, but we do have history
Yep.
where it is lower.
Jen, you said this does or does not include the motor vehicle supplemental time?
It does not, the collection percentage does not include supplemental motor vehicle or supplemental real estate. Those are budgeted as separate revenue lines based on what the tax collector thinks she'll be billing out for the supplementals.
The other thing to recall is that the Board of Finance did do a significant lower of our collection rate during COVID, just because it was COVID and we didn't know what we were going to get into. But the collection rate didn't change, and we ended up with significant extra money.
Right.
Yeah, if I could add one other thing. So this is not about whether you're collecting the taxes. This is about philosophically, how much do you want to place the bet about when those taxes would be collected? So say in a down year that's caused by a recession, you could argue that there's going to be a delay in the taxes we're talking about didn't all get collected in this fiscal year, and there's going to be some runoff collected in the following year, in which case in this year, I've got to draw down from fund balance maybe more than I would have wanted, and I'll collect those taxes in the following year, or it starts to even out over time. So the way you can do what Dan is saying, which is by lowering the tax collection rate, you're shifting more of the potential risk of not collecting taxes. It's okay if you do that as long as your fund balance is set such that you have enough in fund balance if the collection turns out to be significantly below the number that you forecast.
Right.
So because of the way the fund balance numbers are now, I mean, 99.6 is no problem. I'd be okay with even 0.65. Because reality is let's say you come in, you could run a test and say, let's say if we come in at the absolute lowest number you've ever seen, 99.4 or 3, pick that number, and say, what's the impact on fund balance for the drawdown I'd have to do there, you know, all other things being equal, in order to make up that tax collection that year? And does that get us below where you want to keep
So
fund
the
balance?
10 basis points, right, is $140,000? Is that what you, is that what the number was? So if we went from 99.7 to 99.4, that's $420,000, it sounds like. Which is, or call it $500,000, which is, back to her grid, that shows you what the impact it would have.
Well, based on the most that Jennifer's suggesting that you draw down fund balance, you're more than covered,
Yes. Yes.
which is why I'm okay with,
Yes.
I mean, it's your call, but I'd be okay.
It's the
with
right
that.
way to think about it, though, is what's the second level effect?
Right.
on fund balance.
But that, as a practical matter, that's the only thing that's important, I think, across time.
But look at it this way. If we know that our Moody's fund balance, the need, like the minimum amount is going to grow by about 1.3 million per year, right? Let's just say that we know that. Then that would require, I think, that would require an 80 basis point collection discount if we just wanted to make sure that's how much, all else being equal, we spend all of our budgets, all of our revenues come in, budgeting 99.2% would effectively have
The
fund balance
required
grow at
fund
the
balance
speed.
increase that you have to
Yeah.
have for your budget. Yeah, that's true.
So if you think about it at 99.6, we've got 40 basis points, well, maximum of 40 basis points that were of 80 that were kind of pre-funding that growth.
Well, you're building in a collection that creates the fund balance addition you need to
Yeah.
keep up with budget growth.
Right.
Yeah,
Yeah.
it's just this constant
Yeah.
delay by a year, like it's
Yeah,
just getting low.
we could budget 100% collection rate and then just budget in a $1.3 million fund balance growth. I kind of feel like 99.6, and then how about we move through all of this,
Yeah.
and Jenna,
Yeah.
would you support that?
Yeah.
And then Rob doesn't need to tell Kathy that we've gone to 99.65?
Next time I see her.
Oh, I didn't even time stuff for a recession.
Okay. So I think so back to fund balance, are we hearing 3 million?
Yes.
Well, no more than.
Yeah, 3 million on 3.3 million of
Surplus.
Yes,
Yes.
surpluses and excess revenue.
And we're going to assume that the Board of Ed surplus is returned.
Yes,
And we're going to stipulate that we are discussing our budget with that assumption
Yes.
and make it very clear.
I mean,
I've actually spoken to a few Board of Ed members and made it very clear, like, this is like something we're going to have be baked in, and we're going to expect them to be partners as part of that process.
What is their progress towards a non-lapsing account? They can just take the money that they have as surplus and
They're not going to vote on it until May, so we're not going to really know, but we just know what people,
Is May,
conversation.
is it easier?
The
to
board
just
is split.
Conversation.
budget?
To answer that, the board is split evenly, 50-50. So one vote either way. Even people who are not in favor of funding it have talked about setting it up.
Can I
for
just,
not funding.
I don't want to predict another board's behavior.
Yeah.
I don't think that's productive for us to try to predict what they're going to do.
I
I think we
agree.
ought to make clear what we're
Expense.
going to do.
And the Board of Ed hasn't voted on this. They haven't
Right.
voted to create an
Right.
account with zero balance
They
on it.
haven't
They haven't
voted to
voted
give it back
to-
either.
to do
I'm not going
it.
to try to predict what your board's going to do.
Yeah.
You shouldn't. You may be surprised.
Exactly.
But listen, I expect that they'll be our partners in this the same way that,
Yes.
there's a great partnership between the two
My
boards.
concern is that if you don't get it back, it is going to affect what your Moody's potential is. So when you're taking it into consideration, it's whether or not you want to be conservative, that it's not coming back, and then that reduces the amount that you have available for capital. Or, you can still trust them that it's coming back. But with everything else, if it doesn't, and you don't hit your other number, your Moody's number is going south.
Yeah, just,
Get-
let's said another way. If they decide not to return that surplus, you'll end up with a fund balance number that's less by that amount as of June 30th. So the question is the amount that's the 3 million that you're drawing down with all this math, are those two numbers still okay in the event that scenario
It's about 30
happens?
basis points in terms of the Moody's.
Well, that gets us,
Yeah,
I mean, you
it'd be
just
more
take.
like you're
you
drawing down 3.5.
Exactly.
Yeah.
So, if we
So-
were
so
drawing
the-
down 3.5, we would be drawing down more than our surpluses, so we shouldn't do that. But if we could do that and should do that, we can do that based on this grid.
Yes.
But that's just a case to keep the fund balance draw kind of where it is, not be
Yes.
more aggressive on that because you have the risk that they
Yeah.
put that
Yes.
into a non-lapsing account.
Absolutely, absolutely.
Does anybody know the date of when the RTM is voting on the budget?
Yes,
What date?
14th.
Of May?
Yep. So they're voting a day after we have finalized the budget.
Actually, it's May
Well,
12th is Monday.
yeah, well, whatever. It's like they're after us.
I mean, would it not be easier to reduce the budget and ask them to just
Exactly.
spend the money on,
Exactly.
But I don't want them to spend the money on stuff that they don't want.
no, they're gonna
Right.
take the money out of this year's budget.
No, but like
'cause it's been
if we take the money out, then they're gonna spend it
Right.
They can-
instead of doing a non-lapsing
Yeah.
account.
Can I make a suggestion? They have a meeting on April 22nd. That's after we vote and before the RTM votes. Based on where we shake out, we can put together a clear memo and let them know that that excess, which, listen, Rich felt pretty good about it. Obviously, it can move up a little bit, move down a little bit, but we're in April, right? We'll put together a memo and make sure that they're clear of how we created this budget, that we counted on that in connection with our target fund balance, in connection with the Moody's rate, the Moody's ratios we're aiming for, and so forth, and just make sure they're fully aware of that.
Yeah, I agree with that.
Yes.
I just think it takes the drama out. I mean, anything that's in their budget now is all stuff they've voted for that they want to have. If they take 400 and whatever, 60, whatever number of dollars they end up having.
If
taken
we
out
cut
and
their
buy
budget,
stuff.
then they're not turning the money back, because then we've just cut their budget. So if
And-
we
What
cut
they're
their
gonna use,
budget,
we're gonna direct
if
them
we
to
cut
spend
their
stuff
budget,
down. They're gonna buy
we
it.
are forcing their hand.
But they're gonna buy stuff that they took out of next year's budget, is how
But
they're
why
going
would
to
they do
spend
that? Then
that.
they'd be
Because
coming up
there's
short
nothing
next
in
year.
the budget for them to pre-buy, so it's all stuff that they
I think
deferred.
There is stuff, they've just, on the list that's there, none of those were pre-budget numbers. So it's true, they can spend it even without doing that by just buying books or other things like that other boards have done.
If we cut their budget because we're afraid they're gonna do this non-lapsing account, then we're guaranteeing that they're gonna do the non-lapsing account.
Well,
We're forcing
Or-
their hand.
I'm not
worse, yes.
suggesting that we
I'm
cut.
absolutely
Hold
convinced
on
of
one
that.
second, John.
Dan had the operative comment a few minutes ago, do not make assumptions about what some other board is going to do.
Yes.
Make sure your prophylactics are in place irrespective of what they decide.
Exactly.
Given your fund balance draw, you're agnostic about their choice. It is what it is, and you'll deal with it later and let them decide what they're gonna do.
Well, and John, listen, on that, we're making an assumption about what's gonna happen inside their budget. We're also making an assumption what's gonna happen inside the Board of Selectmen budget and all the various town departments and so forth, right?
Right, exactly.
And we're making an assumption based on, the incremental interest rate earnings are gonna come in over the balance of the next like 90 days or so. So there's a lot of assumptions. I feel confident about making the assumption that we get it back. We have a lot of partners in the departments, in the Board of Selectmen, in the treasurer's office, in the Board of Ed office, the Board of Ed department. I feel like we will, it's a prudent, it's a prudent assumption to make.
Did you tell them about the blowout party we planned?
They-
Sorry.
The thing
Sorry, my
that,
bad.
I'm not suggesting that
Just
you
don't
take
put it on
the
Instagram,
400,
John.
because I agree with Dan that if you take the 400, they're definitely spending their money and setting it up.
Yeah.
I'm not saying cutting your budget is off the table for legitimate reasons, because I know people on this board, we're gonna wanna have that conversation. I personally am not in favor of it.
Right.
I'm saying, if we cut it for that reason,
Yeah, I'm not talking about the 400. What I am talking about, and I have the numbers over here, their current budget is at, on the ECR, is at 65% reimbursement. They only had a 67 one year, which was the prior year, which is why the 40 million was added back in and will be added back in again.
Yeah,
Jack, we're not talking about the Board of
Yeah.
Education budget just
Okay.
yet. We're just talking about fund balance.
yeah.
Yeah.
So I hear 99.6 and I hear 3 million right now.
Yes.
Yes.
And so Jen, when you put those in, where are we?
Yeah, 5.5% increase.
Even.
Yeah.
Yeah.
5.5?
And so to
Yeah.
get it,
I didn't come up with that number ahead of time.
to get it down to
Can you go to the Moody's
five,
tab?
we should
5.0.
be
It was at
That's what
5.65
Yeah.
before the change of the 10 basis points.
Sorry.
It was at
the
5.65
sheet that you
increase
had
with
that
the
had
3
the
million
Sheet
unbalanced.
one.
prior
Sheet
to
one.
Oh,
adjusting
yeah.
the 10 basis points.
So the
Minus 2.9.
the extra 50 basis points, if we wanted to get to a
What happened
5%
there?
increase would be what, like,
It's driving off of where I just put the fund balance number in there.
I guess just, I thought that 3 million dropped us to like, was it 562? So the extra 12 basis points is coming from the extra 10 on the collection rate,
Yeah.
right?
Yep.
Roughly, yes.
Sounds right?
That's right,
Yeah.
it goes from actually, we went from 548, excuse me, 99.48 to 99.6. It was actually a 12 basis point increase.
Yeah.
Which is exactly
In the
what's
collection
there.
rate. Right.
Yeah, because the zero assumes the 99.6, that brought us down to 7.35. And then if we do a 3 million, it's a
Yeah.
rounding error, or rounding difference.
Yep.
and am I right that then if we wanted to get to a 5% increase, it'd be about 800,000 more in savings that we'd have to find?
Yeah.
Yeah.
And this assumes all the changes you had listed on your tab, right?
Right,
Well, there are other things that I think that are.
haven't been discussed.
Right, there are other things I think we had agreed to revisit that aren't
On
in the
that
Board of
tab,
Finance
right.
changes tab. I don't, they're not gonna probably make that much difference, but they're
But it's
still
good to
worth.
know, like,
yes,
scope-wise, like, what we're dealing with.
Exactly.
And just to point out, in terms of investment earnings, we've included 3.3
And the 550.
Plus,
Plus 550.
plus 550.
Yep. Yeah, we bumped it up 850 from the 3 million that was in the Board of Selectmen budget.
What's the building permits, why is it 0? Have we,
That was, oh, and I never printed off. Rob had asked if we could have the building department take another look at that. So they have 1,550,000 budgeted right now, but they've been running a little lower than usual on their base permit, not redevelopment permit. So they did take a look at it, and because they know of, I think it was 5 significant home build projects that are gonna occur after July 1st, they think that their regular permit revenue at 1.2 million is actually still a good assumption. And then with Sedgwick, the development on Sedgwick and Thorndal, they are now expecting, we'll call it redevelopment permit revenue of about 275,000 from those. So it actually gets us to, what did I say, 1,475,000?
Yeah.
Versus what their budget is right now is 1.55. Before we had that information, we were thinking we might need to reduce the building permit number.
okay.
But
Yeah,
I
so we-
think based on
Good.
the information that we got from them, overall, in the next year or so, they're expecting almost 700,000 of redevelopment between, permit revenue between Corbin and the other projects. They just don't exactly know the timing. We expect most of all but 50,000 of Corbin to come in the current year, but then the others, Thorndal and Sedgwick, to be afterwards. And then they still get some permit revenue, like the fire marshal's office does, from upfit of the spaces. So when a tenant comes in and has to do things, they get some permit revenue from that.
So we're gonna leave 1,550,000 in the budget. And just to remind
So no
members, we were at 2 million this year. And that's the one that was like, we kind of talk about every month, but it's lagging.
It's lagging.
Yeah,
Yeah.
so I think 155, especially after, I mean, I could send it, Jen, if you want to send it to the group. It's detailed, by
Yeah, there's a
property,
lot
by
of thought behind it,
project.
and I'm comfortable leaving it at the 155.
On Tuesday, the fire hydrant adjustment hadn't been made, but you thought it was gonna be variable, just so everyone knows, that's now in this number, and it's a
Yes.
positive $36,000 variance.
Right.
Right, okay.
And then, Jen, just in terms of other funds, our capital reserve, where does that stand now? Like the Board of Finance capital reserve within the reserve fund for?
400, you have 2 items coming to you on Tuesday's agenda, back in, they're about $15,000. So if you approve those, you'll have just under 470,000 in the Board of Finance capital reserve.
And do we have any, I think Rich mentioned there are 1 or 2 Board of Ed projects that are about to be closed out. They were
No,
sending.
they've already been, the big one was the security one, and you've already closed
And that's
it out.
already in there? Okay.
How do we want to go about it on Tuesday? Is there anything else we can do now that we can save ourselves some time on Tuesday?
Anything you can do now would be helpful, because then I can true it all up, make sure everything
I
reconciles.
have a question, and I know it's not, doesn't impact the mill rate, but I'm just curious as to why in the capital budget, I'm on the Board of Finance changes page, that we have the Weed Beach Meadow and the Pear Tree parking lot adjustments in here, even because those, we talked about a week ago,
Yeah.
that this was just part of the 6-year plan. This is not part of this year's capital budget.
Right, and that's why if the next line below that is assumed bond proceeds, and it makes no budgetary impact. It was really just my note that we're gonna update the 6-year plan to bring them down
Okay,
to
because
the
on
most recent bidder
The
estimate.
Board of Finance summary on line 107, where it says RFC NRE grants revenue, it's in your master spreadsheet, which is just why I want to make sure that it's just, has no bearing, it has no bearing.
It's tying to the
It's
CIP,
informational.
and it's informational,
Thank
and anything that's in here as a bondable item that you're not gonna be appropriating through the budget process is offset by the bond proceeds number.
Yeah, we're not necessarily passing those resolutions.
Right.
Okay.
Just, okay, thank
So
you.
then, Jen, in terms of the $3 million that we're going to contribute, that's all going to go to capital, right? In terms of, that'll be a separate,
That'll be a special
Transfer?
appropriation.
and that's an appropriation that'll effectively happen on May 12th, right? When the RTM approves it?
Well, Board of Selectmen and Board of Finance are gonna have to approve it first. We posted the agenda for Tuesday, but
Yep.
we have time to post a revised agenda.
I guess, do those dollars become effective?
We do it in the current year to
Yep.
create a fund balance on 6/30/24 in RFC NRE that then we use as of
Okay.
7/1/26.
So it's only like a month and a half before the end of the fiscal year, right? When other dollars, because we have like what's the total capital, 5.8, 5.9? 5.9. So should we be talking to the Board of Ed, and can you look through the Board of Selectmen budget? Are there any capital projects that we're specifically supposed to allocate those to?
No.
Where they need to get started 45 days early?
It would be, it'd be nice to get some things started early, but
Okay.
I don't think that's necessary. Everybody put in their budget request with an expected 7/1 effective date.
Okay. So do we want to go through any of the other items that we had, I think, on the Board of Selectmen side?
Sure.
I think things that were out there, I'll kind of kick it off. I've done a little bit of work looking at the AI.
Placer.ai.
Placer.ai, and given some of the things I know, even in connection with Great Island, in terms of some of the value of being able to track sort of the flow of people, the use of some of our properties and so forth, I actually would support that, and I've spent a little bit of time looking at, Rob, I know you had some concerns around sort of the type of data. None of this is data that the town is collecting. This is all stuff that people have kind of voluntarily are giving to app providers, which is then kind of recircled back. But I actually think it'd be a useful asset. It's a $20,000 expense.
I'm
What's
a hard
up?
no.
You good with that?
I'm absolutely a hard no on this. I said it the other night, and when I saw the demo, it's even worse than I thought it was, in terms of privacy. I'm an absolute hard no on this.
Can you explain that to me? Because I think the whole world is uploading location information into the cloud through our phones. We can disable it if we choose to, and many people do, but then that information sits up there and is used by hundreds of companies to make informed decisions. This is one of the companies that's using that information to help the town make a decision. I guess I don't understand the privacy
Because
concern.
The way I look at this thing, unless somebody tells me differently, is it literally zeroes into your IP address, like you individually. I don't need to be tracked by anybody. I understand there's other apps that track it, but there is no way I'm supporting $20,000 for this app because of the lack of privacy that it provides, or it does not provide, I should say.
But your location's already being tracked by hundreds of services that get your
I just
information from your
feel-
phone.
I just feel like it's wrong for the town to use where I am anytime they want to see it. I don't know if anybody else is concerned about that, but That's ridiculous.
I don't think
in my
so.
mind.
But Rob, just be clear, it's the town's not using where you are.
No, they're not
The
using.
town-
But they're getting it from, so,
Yeah.
it's word salad at this point, right? But if somebody, it just is.
Well,
No, the town
I
doesn't
mean,
know that.
did you guys see the demo? Did you look at the demo? Did you see the stuff that can be produced? College graduate ethnicity is in there? Really?
yeah, so it's anonymized such that you can't identify individuals. I mean,
Then John, how's it get ethnicity?
well, because it has individual data, but the data that's supplied
There
to
you
us
go. You just
is
said it.
anonymized. Okay, so we're not going to have access to individual data or individual locations of anybody. And if you think about it, a far more intrusive thing is things like license plate readers, right? We know that you come into town because those are all read by license plate readers all over town, right?
I get that.
That data is
But
not being used.
I see
but-
I see the
but-
criminal element that, if you want to call it that, right? If somebody's car gets stolen around here, if we're looking for somebody who just committed a crime in Darien, I get the license reader. I don't get this at all.
And
No,
then
no,
we'll
no,
just
you-
launch
but you don't
information
understand, but you
associated
don't understand.
with
So
yours.
that system of the
Just
department,
ethnicity or like
Hold
income
on.
information.
Let John
the
finish.
system of the department knows exactly where you are. They know that you've come into town, they know when you came
Which
into town.
does?
Because through LPRs, they know when you came into town, they know when you've left town, they know what exit at all times.
I get that.
Okay, but they're not using that data for the purposes of knowing where you are.
I would
Okay, so
have,
the
I'd
data
rather
that-
have law enforcement
that-
see that than Parks and Rec. No offense to Parks and Rec.
Parks and Rec is not seeing that data.
How are they not, John?
There's no, we have no data is being supplied to us that tells us where you are at any time in town. None whatsoever for Placer.ai. That's not the whole point of this.
Then how do they know a college graduate who's white is going to Cherry Lawn?
Look, to Dan's point, there are all these companies, they all know where you are. Your Apple right now.
I understand, I get it.
Right,
I'm
but-
just, I get it. I don't want another thing out there. Look, I'm not getting convinced. I'm a hard no on
Okay.
this.
All right, so he's not going to be convinced, I would drop it. I'm still very much in favor of the insights we could get from this to save us money and to organize how we
I think
handle parks, everything
it
else.
uses data to inform decisions instead of judgments to use decisions. That's
The-
why I'm in
The
favor.
minute we get a sense that personal information by individual is being revealed to the town or is used in any way, which was made clear to us that that's not going to be the case, the minute that happens, we'll shut it off. We're not going to, we have no interest in that. We're just trying to plan programs, parking, answer questions about traffic, all of that, which we simply can't do now.
So that was one item.
Next.
Next.
Does anyone, well, just in terms of, understand your concern, but just in terms of the $20,000 for or against it, is the sense here that people would support the $20,000?
I think I'm with Rob on that one.
Okay.
I'm supportive of it.
Okay, Paul?
I really don't care. I don't know enough about it.
Okay,
I'm supportive of it.
okay.
Especially if you've talked to other municipalities that have done things like this.
Yeah, what you find is, there was a Westcott discussion about that
I
yesterday.
support it.
Other municipalities have tried it. It's actually not the privacy data, it's the vendor in terms of whether they were providing the right service and helping them analyze the data. But I asked the question, there's been no concerns about individual or privacy issues with any of the data that they've looked at.
So I would support it. It feels like we should talk to Jenny, but we can make the final decision on that on Tuesday.
Just to be clear, like, it does seem like it is tracking individuals, the data is going to the company. The company's not giving that data back to Darien, but the data exists. So I would think that there's a risk that that gets hacked, right, that's out there.
But I would,
Maybe you can track me some other way, fine, but with taxpayer dollars, I don't see a need to
any app that you
create
put,
that risk.
any app that you enable location services, you're giving permission for your location to be tracked. And that information is being sold. So this is just one of the companies that buys that information. But it's not creating any more information that doesn't already exist.
But
That's all out there.
But just
So it's just one other company that uses that information that you've already authorized to send up into the cloud for the purpose that it's for the community.
okay. Well, let's move on to this. I think the other item we talked about was the sort of sustainability, the
Financial sustainability study,
what I've-
Parks
yeah,
and Rec capital
yeah.
budget.
What I sort of described as a sort of program or a consultant or a study that would begin to help allocate costs within Parks and Rec across different services, across different assets, across different programs. That was one that I didn't necessarily see the value to the taxpayer or the value towards some type of efficiency on. And at this point, although I could learn a little bit more about it, I didn't necessarily think that was one that would help it.
The goal of
Jenny-
that one is similar, data-supported decision-making on setting fees and determining how much cost we want to recover,
So-
rather than a judgment, and it feels like we should charge this much.
Jenny and I presented that item during the Parks and Rec budget discussion, and we were both curious as to whether it could be expanded across other departments within the town, and we were advised that it could not be. That would be, which I.
Each one would be a discrete study.
Well, and a discrete expense.
Yep.
So I'm not, so that, the fact that we can't expand its purpose soured me on the project. I think it's, it's a nice to have, but it's expensive for a very narrow purpose. If that purpose could be expanded, which apparently it cannot be for the same dollar amount, then I would be supportive of it, but it can't be.
Well, other than to say that I think this would be the first time that we would have a study that would come in and try to tackle this philosophical issue about what's something that should be just charged to taxpayers and funded through general tax revenue versus something that's more user fee based, and sort of what's the right balance between all of that. And so even though the particular program would be geared towards Parks and Rec type questions, right, where you've got beach stickers, you've got court user fees, you've got all of that, you're still actually making a decision against that philosophical anchor, right? And I think actually the learnings from that could inform other efforts where maybe we've gotten sophisticated enough in terms of making those trade-offs that we don't actually need to have a consultant come in and do that. So you could say, all right, now it's time to do the same thing for public works or other areas of town where there are fees being charged. And maybe we now know enough about that philosophical trade-off that we have a point of view as to how it could be handled. So I don't think the direct things from Parks and Rec, this effort could be used, but the learnings on that philosophy could. The other thing I would say is that, didn't Jen use the same thing in Westport? And they had some fairly good success in bringing order to their overall program for how they charge fees across a wide variety of programs. She thought it was very successful when they used it in Westport, which was the genesis of this particular idea, and why we thought it was a good idea to try it now.
How much is that item?
36,000 and 100, 36.1. It's a cost accounting. It's basically allocating costs against.
Well, but it's also developing a philosophy where you could say, this is the type of thing that we want to be user-based in terms of the economics, and this is the type of thing that we would like to see just charged with general tax revenue. I mean, we've just talked about this for 10 years about kind of what's the philosophy or almost checklist model that you would have that says, all right, if it feels like it's this side of the ledger, we'll do user fees versus others. And I think there's enough of that type of uncertainty that it would be useful to pursue this, particularly given Jen's success with it in Westport. That's the reason we proposed it.
If we can go and take what they did, which I think that there's enough bright people here to be able to do it, it's just the resource. But I'm also thinking, when I've listened to Jeremy, how he comes up with his planning and zoning fees, it could be very helpful there because he actually breaks down all of these component parts to figure out what it's really costing in that. So there are other applications. We just may need to see how they're doing it, and then we could throw our own bodies at it to come up with it.
I don't know, I mean, in here we're trying to find dollars, like this might make a lot of sense in general, but could be postponed perhaps. I mean, if we're looking for dollars to cut, I don't know that we feel we have such an urgent need right now that this can't hit the chopping block, so I'd be a no.
I'd be a no also.
Okay. Lynn, whereabouts are you?
So they wouldn't weigh in on the like catalog of offerings from Parks and Rec, right? Just on
Right.
how the fees work.
Well, and I think it's more of a, getting input from the commission, from the department. It's not the outside consultant deciding what our philosophy is.
Right.
Definitely with input from the people here. But no, they wouldn't be saying you should no longer offer X, Y, or Z. That is entirely our decision. We may find as a result of this, it costs us an astronomical amount, and maybe for the number of users that we have, we don't want to offer it anymore. But that would be our decision.
And we
Yeah, I
don't need a
don't know. I
consultant to
mean,
make that call.
I think we need more information for things. Like Jack and I have talked for years about what are we offering and what other organizations in Darien offer similar things, and like what's our philosophy on that. Like if there's other, like I don't even want to put something on the table because it might sound like I'm not supportive of it. That's not really what I mean, but like why do we need to offer some of these things as a town? Is this just because it's something we want to provide for our residents, like camps or, whatever, and like what that universe of stuff looks like? And who are we competing with? But this is different. I understand this is different.
But for that question, I think it's about setting a standard for Parks and Rec that says either each individual program or whatever grouping of programs you have has to be net positive. So go price that such that the projected quantity will yield a quote profit based on the resources you have to put against that, and we're done. Right, so you could, if you adopted that standard and said just communicate that to them, and you'd kind of be good on that dimension. This is a different question.
Yes, if the information though helped us get to some of that, I think there's savings possible, because I think we compete with other nonprofits in town. I think we compete with, other commercial entities and things. I don't know, but
it's not just savings. It's that there's gaps in what we offer in certain places. So this may allow us to redirect what the town is spending its money on to fill the gaps that are necessary, instead of just having 5 different organizations do the same thing.
Oh, that's not how I understand the study.
Yeah,
How I
that's
understand
right.
the study
But I
is
know that's what
here are the
we're
programs that
doing.
we're providing, and we're charging a user fee of $55. Our actual cost is $42. Great, we're making $13. Should we be making $13? Or we're
That's
actually,
right.
it's actually costing us $85 and we're losing $30. Is that okay?
Right.
It's not whether we should be offering the program, it's
Yeah.
what is the cost of offering the program
Well-
as it relates to the fee that we're charging.
Well, the slight nuance I would say is you could come out and say that, and then this came up in Parks and Rec the other day, to provide baseball for kids, I'm making up the numbers, but I think this is right, it's $50 per kid. And so you're looking at parents coming in, oh geez, I paid all this, now DHS is charging that, now the town wants to charge $50, and it used to be $5. And you say, well, we want 50 because that's covering the cost of that. Okay, so that's one philosophy. The other philosophy would be to say, now we're gonna leave it at $5 or $10. Why? This is a little league town, and that there's an interest in the town providing some support for that, so parents are not paying a sort of all-in cost through their user fee. And we run into this philosophy in other areas where some of this debate could be helpful. So for example, the cost to rebuild the boat ramp at the boat club, all right? So maybe, what do we say? Is the boat club supposed to pay 50% of that, 80% of that, 100% of that? Or does the town have an interest in saying this is a coastal community, ergo the town should have a role in funding some of that out of taxpayer dollars, because maintaining us as a coastal town with those resources benefits all taxpayers. It's just an attempt to try to answer that question so that when we do get it in the future, there's a philosophical underpinning that says we've kind of made that decision, and therefore this particular decision coming up should be decided this way. I don't know if you can get it that clean, but I think that's what they were wrestling with Parks and Rec, because they didn't really have a way to anchor a decision about just sort of how much is the Little League fee supposed to be user-based versus taxpayer-supported, and they didn't know where to go on that continuum. This is meant to try to
John,
bring
that's
clarity to that.
That's a policy question, and this, I think, software or study, if you will, right, is more meant to just say, this is how much we're spending, and allocate the cost to all the different services that we're providing. And so the idea is, if it costs this much to mow the field, we're going to allocate this much to soccer, this much to lacrosse, and this much to just the public, I mean, I just, there just seem to be so many subjective things. Are we going to allocate the $6.5 million cost of Highland Farms to the 2 or 3 soccer programs that we run there? I kind of, because the other aspect is that, well, the school offers these, and Chelsea Piers and others offers these type of camps, so it's, you know, ultimately, if we truly allocated all of our costs, including the cost of the real estate and so
Well,
forth.
you'd stop doing a lot of things.
Yeah.
But also, I think, using Highland Farm as an example, it's not just soccer that occurs on there. It is a walking area that the general public goes and use, and them being there and walking doesn't exclude anyone else from using it. So it might end up more on the, we don't charge for Highland Farm, or the soccer activity is 1% of what occurs at Highland Farm, so we allocate 1% of the Highland Farm costs to soccer.
Or we decide that just philosophically, the town is better off by having these services or these types of activities available to our youth, and therefore we're okay with adding a little bit to
I
support that.
guess I'm struggling a little bit, John, with what are you going, you're going to have all this information, and then what? Are we really going to say, all right, okay, we've been charging our Little League parents $5 and we're going to charge them $125? Is it really going to change the way we think about charging our residents user fees? I can't imagine that it would make that material, it would help us understand whether we're making money or losing money, but then what? And then what decisions are going to be informed by it? And I guess I'm a little skeptical that we're going to start changing our user fees as a result, materially as a result of this, versus subjectively kind of where you'd kind of
Well,
sense
any
things are
material
already.
fee would simply be implemented over time, right? I ran into this the other day where it was that we were getting the pickleball costs up to what the actual cost was for the guys who play pickleball through DMA. And so if you implemented it all at once, right, because they had, I don't know what the discount or something that they were not paying full fee, significant discount. So to ramp that all up, I mean, that was a big number for them. And so you layer it in over time so that they don't pay the full amount up front. It's just a question of the prices are going to be a reaction to what you decide philosophically about making decisions between taxpayer supported versus user fee supported.
If this was something that was an effort that we want to undertake with the entire town, what we charge downstairs for the folks to do for like building permits and so forth, that we truly looked at what the cost of like sending somebody out to inspect that project 10 times. I mean, the easy example I look at is a false alarm. I mean, I think it's $100 for a false alarm.
Something like that, I forget.
The
But-
cost of moving,
In a fee like that is also an attempt to change behavior, not just recover costs.
well, yeah, and I guess on that behavior, like with some of these camps, like the behavior is, we kind of want our residents to come out and enjoy it.
Or
So-
we're fulfilling a role at a more affordable price than what the private providers
Right.
Yeah.
are doing.
I think unless we perceive an acute problem, this is going to be a lot of uncomfortable and difficult conversations for hours and hours and hours. And unless we really need to solve the problem, I don't feel the need to do this.
Well, we wouldn't be proposing it if we didn't see a need to solve the problem.
John, could this act as a prototype for activities in different departments?
The Parks and Rec guys would tell you from their budget presentation that the specifics of what they're talking about in terms of Parks and Rec activities and fees don't translate in detail to other departments. But as I said before, the clarity that I think we'll get on this broader philosophical question will in fact be useful for all departments in a way that would obviate the need for hiring a consultant again to do it.
Okay. And I guess I understand like the value in a cost analysis. I guess I just haven't necessarily been able to digest the entire, like the path in terms of how we're going to think about, allocating costs of insurance, the value of the property. Did we pay for that property? Did we not? How much do you allocate for mowing, like the field to the soccer camps versus like, for instance, like Great Highland Farms, just people walking around. To me, it just felt a little bit nebulous in a year where based on where we're pointed right here, it's probably going to be the highest mill rate increase that we've seen in a long time. So, Are there any other issues that, things that people,
The only other thing I thought we had agreed to revisit was the sidewalk consultant.
Yeah. I'm a no.
I'm a no.
that was 20,000, correct?
2468.
No, 20,000. Even.
20,000.
Yeah.
So if I could review briefly why we've requested this. So
No.
we've had a number of requests, a lot from parents, but broadly across town, to take another look at our pedestrian infrastructure, mainly sidewalks. So that was last addressed in 2015 when they had what was called the Pedestrian Infrastructure Advisory Committee that was set up by the Board of Selectmen to try to do this. That committee was comprised of all civilians, and so they went out and did a pretty detailed study. I think you could get the report. I have it. It's about 130 pages. And they went through sidewalks, they went through bike paths, they did crosswalks, they did a very detailed analysis with pictures, diagrams, and all of that. A few things were done out of that study. A lot of it was rejected. And the reason is that the proposals that they came up with were not realistic. And they weren't realistic in many instances because of things like you can't build a crosswalk across a road when it's not connecting sidewalks. You can't you can't just say, I'm going to put in sidewalks in this particular place because that's what people said where they wanted the sidewalks, because they didn't take into account other complexities like utility infrastructure or the need for easements or the topography that made building the sidewalk difficult, or the fact that it would serve an inadequate number of people given the cost of that sidewalk. So a lot of the work that they did, as much as it was very helpful for everybody to take a look at it, ultimately ended up being wasted. And so given that everybody's come in and said, we really want to do this, having somebody who's done this, and the particular individual that we've looked at just finished something similar up in Stratford, the idea or the theory of this case is let's have Pedestrian Infrastructure Advisory Committee version 2, but this time let's set it up like we do a building committee. So a building committee has civilians that come out, or from the town that come out and work on the committee, but they're paired with professionals at all times. So these are architects, these are contractors, project managers, people who do this for a living. That says, yep, we're going to work with you through this process to get to an end product. What we'd like to do is to come up with a sidewalk plan, right, that has the oversight and collaboration with a professional who does this to help ensure that we've got the right criteria, that we've taken into account the entire town, that we've got the right set of decision-making to come up with a proposed plan that we can come in and say, all right, here's the plan that's got this prioritized against the criteria, that we can go out and say, this has got the support of the town because we had a professional involved. Now, we could go down the path of letting another civilian group do this and not spend that money. It's a small percentage of what we might ultimately spend in terms of sidewalk infrastructure, but for that amount of money, to get someone's help to get this right, to where it also gives credibility to the new sidewalk committee that says it wasn't just a bunch of folks there who had their desires, or they only joined the committee because they wanted sidewalks right there, and by golly, I got the committee to vote for it because that's where I wanted a sidewalk. It's a professional come in and ensure that that process is free of that kind of bias and has that sort of professional, non-biased stamp on it. And I think it's going to be a lot easier to sell, particularly if it ends up recommending that we expend a fair bit of money to put in sidewalks. Without that, you run the risk of having the recommendations be viewed as biased towards the beliefs of individual committee members. And that's, I think, what we had in the last committee study, and that's the reason to do this and why we're trying to avoid that outcome.
I would hope that a building committee that was formed for this purpose would not have bias to build something for their own parochial interest. I don't think any of our building committees have suffered from that concern. Whether it's a school building committee, whether it's the Island Advisory Committee.
They don't.
So I'm not concerned that
But keep in mind, if I could interrupt, keep in mind that building committees are charged with executing a plan, okay? We're taking the building committee approach and applying it to a strategy or design development, right? To avoid the problem that we had the last time and try to replicate the success we have with sort of civilian professional partnerships with building committees.
all I'm saying is I think we could put a committee together of residents in this town that wouldn't be biased with parochial interest.
You'd be
If it was
surprised
done
how many people try to sign up for committees that have a biased interest in that. I mean, I'm just saying.
I'm aware of that phenomenon.
Yeah. And by the way, so one of the things we also, I don't think, want is to have a committee of 15 or 20 people trying to decide this. That's going to be pretty inefficient. It needs to be a much tighter group. And the tighter the group, the more you have at risk in terms of people believing that their interests are not represented in the group because maybe their person's not on the committee. Look.
I think that criticism
you
is going
could
to come whether there's a consultant or otherwise, but anyway. Whether it's fair or not is a
point.
completely different question.
You could do this. I'm reluctant to constitute a committee that is not on a tight leash for this for that reason.
Can I ask 3 questions that maybe just might help us either take away and make decisions on Tuesday or not? One, Jen, I think this year we have about $500,000 of sidewalk improvements.
That's about how much we spend every year.
Yeah, so yeah, is that the annual cadence for both rehabilitation and for new sidewalks?
No, that is only for rehabilitation.
What's our
Very
average?
rarely have we done appropriations for new sidewalks in the time that I've been here.
Okay, and then second thing is on the plan of conservation and development that's going on right now, like we have consultants, I think, working with us now?
Yes.
Or is it, does that touch on like pedestrian strategy or anything, and does it make sense? And John, I hear like the need to have a little bit of a professional outside voice on this. Does it ever make sense to tie that in, or at least wait till, when does that have to get published?
Basically a year from summer of 26.
Like, is there anything going to come out of that in terms of our strategy, given all these developments that are going on?
So maybe, but keep in mind, they have such a broad remit across everything that goes into a plan of conservation and development that this would be, a 10-minute effort. Yes, you need to prioritize sidewalks, but you're not really going to have any more detail than that. In other words, it's not going to be insightful about how we're supposed to prioritize sidewalks and make the decisions in terms of exactly where to put them, but also go through the process of saying, because keep in mind, once you do this strategy, you want to have a plan that you can then turn into a bid document and get somebody to go out and actually build. There's no way a POCD process is going to generate the amount of detail that you need for that, and you're going to have a separate committee to work that out with a professional in any case. Because keep in mind, the infrastructure committee document from 2015, there was no work that went into that costed any of that, for example. It was just sidewalks to put in places.
So then, John, assuming this consultant came out with, I'm going to kind of use an example, these are 10 places we should have sidewalks, 10 different mile-long sidewalks, right? And that's not something I would imagine just based on the cost of sidewalks that we would do in any one year, right? So when that report is generated, would the Board of Selectmen be the one that's looking at that report and making the decision that's saying, I do support that one, I don't support that one, I want to do this one first and this one last? Who would actually be making the decision?
No different than what we're doing for Great Island. Same process, right? So ideally, I'd spend a lot of time with this committee because I'm interested in it, but ideally what they do is come up not just with a prioritized list that says, here's your list, but it would also be sequenced that says, all right, if you were to do it, prioritize this first, this next, this third, something like that, so that there would be a recommended sequencing and prioritization for the Board of Selectmen and you guys and the RTM to consider.
And that would fit in with, I think Ed's history has been, he's always made sure sidewalks aren't done, or they're redone, if you will, at the same time that he's paving roads to try to...
All that, yes. Yeah.
My concern is that this sends a message that we are open to doing more sidewalk building, right? This is not to take sidewalks away, so it's only to spend more money. And given the debt burden that we've taken on, and I am personally still concerned about whatever flood conversations we still have to have, this is not anywhere near the top of my priority list for spending, so I'm a no for now. Later at some point when we are in a different place, maybe, but not now.
This is immaterial in terms of implications for our debt load versus other projects we're considering. It does not move the needle.
I think to build a new sidewalk would be over $1 million, right?
Nope.
No.
No, not at all.
Depending on the stretch,
depends.
we've done them for $75,000, $120,000.
Yeah, the super expensive ones come into place when you've got topographical challenges, or you're moving electrical infrastructure, or you're rebuilding road signals. That's why the one that some folks want in Ox Ridge, sort of between the entrance to Oxridge, up Mansfield to Pembroke, why that is potentially so expensive is because it includes those elements.
Yeah, are we really considering sidewalks, if you're that familiar with it, that are gonna be inexpensive?
Oh, sure, we've done a lot of that, and I'd like all that stuff identified. If it looks like it's both inexpensive and something that people would really want, I mean, examples of that have been extensions that they put in place. So for example, Norotan Avenue, down Heights Road to the entrance to the parking lot, the Norotan Heights train station, there's been no sidewalk there for years. And I mean, I've used that many times and have seen many people using that. That was super cheap to put in. No electrical infrastructure, no flood problems, it's just a concrete strip. And that was one of them that was low cost like that.
Okay. Can I make a suggestion on these three issues, unless there's others? Let's all think about these. I think you've given us some good data. If you have any other questions, the only one that would come to mind right here, Jen, is if Ed maybe had a ballpark estimate what a normal sidewalk is, like, I don't know, per mile, per...
He's got a list. We can supply you with the costs of the last 15 sidewalk projects.
Okay, but if anybody else has questions on this, let's kind of get them back tomorrow morning, just so that we can, if you guys need to think about anything over the weekend, but let's kind of be prepared we need to knock these things off first thing on Tuesday.
The only other thing I was gonna propose, and I know I've mentioned it once before, and I don't think it has a lot of support, was the mechanic that hasn't been hired yet in Public Works. Is there any appetite to make it a half-time to start? It would cut the benefits and half the salary, right?
If you're asking me if I support it?
No, the
but
amount.
That would be, it would cut the salary and there would be no benefits. But it is union work, so that could be an issue that the part-timer wouldn't be in the union, you'd have them doing union work because it's the same job that Dave Sabini, our current facilities mechanic, is doing.
Do we have any part-time Public Works employees?
No.
Okay.
Unless they're seasonal now, I don't
Right.
think, yeah.
I just want to go back to something else on the sidewalks. We have done new sidewalks, but under the new guideline that anything south of $1 million, it will not be bonded. We may have bonded some things in the past because we were bonding things and money was cheap. But none of the prior ones where we did new sidewalks would qualify for bonding, and that goes back about 5-6 years. I mean, I think the last one was like 75,000 for
Yeah, there was a
something.
75,000 and a 120.
Yeah.
Okay. Any other things inside Board of Selectmen, budget, capital?
No.
Okay, Jen, anything else you need? I have these 4 things that we're going to come back on. That one part-time Parks and Rec, we have Pacer, we have the Parks and Rec sort of financial stability, and
Sidewalk.
the sidewalk.
And are we gonna talk about ECR and Board of Ed or no?
So on that point, I would just say, on ECR, we only approve a budget. That's a revenue, that's,
But it
2%
modifies
of their, 1.5% of the budget. What?
It would modify the number.
Yeah. I think if you moved it from 60, I think if the Board of Ed was to receive 70 versus 65, it'd be about 200 odd grand.
It would be 200,000, but the deal was, when I spoke to Jill and to Adley and to John Senior about it, is that they have a number in their budget now. If we increased it by 200,000 and they did not get back
Right,
that
then they'd come back.
money,
Yeah.
we'd make them whole, which is easy enough to do. It's 200,000. But one of the other things that we've just seen is that even though we've gotten lower rates on some of these things, we've still come very close to what we had in the budget, because what we're spending on certain students has also increased. So it's something that has to be agreed to by both parties, but it's a financial thing that they're make whole either way.
Right.
Well,
So,
again, I would ask you not to predict our board's behavior down the road. I understand that we're likely to, if they have a shortfall, we're likely to, but I don't want to start predicting circumstances or hypotheticals.
I'm not doing that.
I'm more concerned with, as our esteemed colleague Paul, who is the most informed on this board on the subject, I would think, because of his role, it's a crapshoot as to what's going to happen a year from now. And it is a very, very small percentage of their budget, extremely small percentage of their budget. So I am a hard no on modifying the school board budget as it relates to this matter?
I will update Jill that this has been discussed. Their next meeting, I think I said, is April 22nd, so it's after we vote on the 8th and before, Jack, you and your colleagues on the RTM vote on the 12th. If that's something they want to revisit, they have in the past made sort of adjustments because they had updates. I'll raise that. I'll raise the point that that's been discussed.
I just want to make one comment. It was mentioned by Adley, and quite honestly, your chair has said, and I have said to the Board of Ed, that if, on certain decisions that they've made, if they need the money based upon those decisions, raise your hand and we'll give it. So it's not a prediction, it's something that your chair has said to them, it's something that I said on F&B in front of Board
I
of Ed
think to be
meetings.
clear, we've said
So-
we've always done it before.
Yeah.
I don't think anybody has promised anything as to how we're going to behave 6 months from now or 1 year from now.
Yeah.
So, and
Fair
I
enough.
do not want to get into the business of predicting how this board is going to
Fair enough.
behave, to react to something that we have no idea what the context is at the time it's presented.
So, listen, we're not going to discuss that more tonight. I'll talk to Jill. I do think, Jack, this is something that kind of feels like their next meeting is between our two, but so it might kind of fall, if they were to make a change, I'm sure the RTM could make that adjustment, the accompanying adjustment on the floor that night.
Jim, in the 17 years, no Board of Finance has ever touched the ECR percentage in my budget. So,
Well, yeah, and we can't touch that percentage. We can only increase what we actually allocate to them and how they allocate it. So I'd like to just, given it's late and our finance director and town administrator is doing two jobs, maybe more. Jen, anything else you want us to be focused
No, I
on?
think we have all the big numbers, it's just fine tuning things.
That emergency management director was not on the table for part-time, was it?
Emergency management?
The assistant fire marshal / EMD.
I thought we took that down.
The
No,
assistant,
the fire administrator was
Fire
requested
administrator.
a
No, that's two
full-time
different
and it's
things.
taken down to part-time.
Yeah, let's take it.
The
But then-
assistant EMD was requested as a part-time, but the budget has it being covered by 20% of one of the deputy fire marshals, and the budget includes a new deputy fire marshal to assist with the catching up on the volume of recurring inspections due to multi-dwelling.
And that's full-time position.
Yep.
Right, I think
So there were two full-time positions proposed.
Yeah.
One,
We cut that.
we discussed keeping, the other we discussed moving to part-time.
Yep,
Yeah, and I think if you just scroll up on that,
yes.
it's
We
right,
have it.
it's right there, Taylor. See the
That's-
change fire administrator, part-time, 39,000.
That's fire administrator, yeah, but I was
Yeah.
talking about the other position.
The
That-
EMD is planned to be covered
wasn't-
by
yeah.
part of a deputy fire marshal.
Jen, last thing on debt service, we're going to be in the market, I think, late morning on the 8th, on the morning that we set the actual vote. What do we, in terms of interest, how much, the new bond deal will only contribute interest to the budget, right, no principal?
Correct.
So what's the total interest that we have? The
In
incremental,
budget,
yeah,
1.8,
okay, 1.8 million,
it
and
was
so,
like 1,775,000.
and so like, I mean, a 25 basis point move in interest rates would maybe increase that number 5% up or 5% down, so if it's a million, you said 8?
Yeah, I think so.
I mean, 5% there is about $70,000, right?
Well, but remember, we talked the other day that the estimate is $300,000 more than what's in the budget because you chose to do that extra 3 months
Yeah.
of HHR.
Yeah, but what I'm saying, in terms of absolute rates, just to help you guys size it, 25 basis point movement one way or another, it's I think like $60,000, $70,000. It's not a large amount in terms of other things moving around.
One thing we didn't talk about was healthcare insurance. And I think
Oh, yeah.
from Tuesday to today, there's been a development.
Yeah, we weren't able to reach an agreement with one of the unions. They were the first one that we just couldn't, we reached an impasse.
Yep.
And what we had told all of the unions was, if we hear a hard no from one, we will let you know, because, they're doing a lot of work on it too. So we confirmed in our meeting that it was a hard no from that particular unit. We did tell them that we would inform everybody else. We did give it a couple hours to see if maybe there was, a change of heart upon reflection. We didn't hear, so we did tell the other unions that it was a no.
So that $500,000 is not no longer part of this budget, that $500,000 savings. I think you suggested there might be some room with UnitedHealthcare,
So,
but that sounded like maybe it was,
The other angle to
Hopeful.
UnitedHealthcare is, in the course of looking at the move to the state partnership plan, I had asked our broker about what if we went January 1st, just because there were some concerns about people changing HSA in the middle of the tax year, so what if we did a full tax year? When he reached out to UHC, they confirmed that they only need 30 days notice for us to terminate, but they also said, you know, what would it take to keep you for a full year? So we were holding off on replying with anything until we kind of kept that in the back pocket in case we did hear no from the unions on the move. So we have initiated that conversation with UHC.
do you think you'll have news by Tuesday?
They just reached out today, because again, we kind of held off just in case there was a change of heart. So this afternoon, he reached out to UHC. I don't know, and he wasn't overly hopeful. Our rep said, you know, I'd like another chance at it, but I don't know what underwriting's gonna do.
So unless we hear back from you, no change to
Yeah,
what's in
and
the
if we hear back
enrollment.
after your vote, we can make a
Right.
change at RTM level.
Okay.
Okay, thank you.
What was their position against the SVP?
It was negotiations, so I'm not at liberty to discuss that. It was, and I guess I could say it's not against the SPP. It was that we couldn't reach agreement on an MOU regarding the move.
Okay. Well, Jen, appreciate your work doing this. Appreciate your work
Yeah, thanks.
on this, and Susan, whoever else has been kind of helping you, and certainly for the unions that have considered this. This is a kind of big savings for the town, so I appreciate their consideration of it, so. Okay. If nothing else, I'll entertain, motion to adjourn. Malin moves. Taylor seconds. All those in
Thank you for
favor?
giving me that chance.
We stand adjourned. Yeah.